Hey, this is Sasha, and welcome to another episode of Let's Talk Stocks. And in this episode, we're going to take a look at option Greeks. We're going to look at Delta, Gamma, Theta, and Vega, and we're going to make it easy. That way, if you're learning to trade options, and you're confused a little bit about the Greeks, what they're for, how they're used, that's what this video is going to explain. I want to simplify it to the basics and really the big picture behind it. So as you take a look at this and look at option Greeks, you really got to understand the whole big picture behind them. So they're technically an indicator for you. So if you look at this indicator here that we have on screen, this is a volume indicator. And you know what it does, right? If you move the volume bar up, it's going to be louder. If you move it down, it's going to be softer. If you look at a car gauge, this is the same concept of what Delta, Gamma, Theta, and Vega do for you. So looking at this car gauge here, you can see, okay, we have our speedometer there that tells us how fast we're going. And if you look over here at the fuel gauge, it tells us how much fuel we have left in the car. So it gives us an indication of if we're getting close to when we need to refill our car's gas tank. So this is really what Delta, Gamma, Theta, and Vega do, is they're indicators. If you're sitting on your trading platform and panel, it's going to tell you, okay, what's going on with this issue, what's going on with that issue, where are the risks. So here in a car, because a car uses speed and it needs gas, these are kind of the things that you need to know when you're in a car and driving forward. When it comes to option trading, you need to know and understand Delta, Gamma, and Theta, and Vega. These are your indicators, your drivers. So if we look at Delta, Delta is basically a change for every $1 move in the stock. How much money are you going to make or lose? That's what Delta tells you. Okay, so for every $1 move, okay, it's $1 move. It's always $1 move. How much money are you going to make or lose? If you look at Gamma, it's how fast the delta changes. Okay, so Gamma is related to your delta. How fast is that delta going to change? Your Theta is your loss or gain regarding your time. Okay, so how much are you losing or gaining on a day-to-day basis, which is basically your time problem that you have with options. And Vega is your loss or gain due to volatility. Okay, so based on volatility, because options are priced in volatility, think of this as, how full or low your battery is, right? It's a whole different indicator. It could be your RPMs. It's just another indicator. That's all it does. And because options are priced within volatility, well, that's what Vega tells you. So when you look at this, it's really your risks. The Greeks are your risks. So Delta tells you your price risk. Gamma is the change of your price risk. The Theta is your time risk. And Vega is your volatility risk. Now, yes, there's also rho, but that's interest rate risk. So as we get into this a little bit further and start looking at this on a trading platform, I want to share with you what this looks like. So here, if we look at Apple, here's a single contract, the October 2018 220 call. And I've just chosen this because it's kind of close to the strike price, but let's just look at our overall Delta, Gamma, Theta, and Vega. These are our risks. So Delta is your price risk, Gamma is related to that price risk, Theta is your time risk, Vega is your volatility risk. So let's look at what this really tells us. So Delta, starting out, this is the most basic one that most people know. Delta is 45.63. That means for every $1 move in that stock, I make or lose 45.63. So look at it right now. We are starting out with a loss of 250. So if I move this price slice, okay, so if this price slice moves, you can see the profit and loss also moves and adjusts. So let's say we move this to a positive $1, okay, you can see I'm up about $42, which is basically our delta. Now that delta continues to increase due to the Gamma, but we'll get to that in a second. So again, if I go ahead and let's just say add another dollar, let's just say we go up $2, well, my delta is now 48. So take $48 and add another 48. So right around, $96, $98, depending on the rate of change, but it's going to add another $48 to my current profit and loss. So there you go. You can see we're right around $92, $93 as the stock price continues to wiggle. Okay, let's add another dollar, right? So if we go to plus $3, we're going to add 50 delta, right? 51 delta. So now 91 plus 50, call it 90 plus 50, about a 140. So there you go, 146 is what we get. So we're up about a 146. Now, if we go the other way, remember, we're positive delta here. So let's reset this back to 0. If we go the other way, well, we lose $45 because we have a positive delta. So if we go -1, okay, you can see we're down about $47, right? If we go down 2, well, subtract another $43 from this. So you should be right around, let's see here, you're going to get about $90 of a loss. So you can see how delta really works. Now, with delta, keep in mind, you notice it wasn't really perfect. That's because of this gamma. The gamma is the rate of change to the delta. And all that means is that curvature, right? So that curve, how fast accelerated that curve is, right? So if we go in and add $1 to this, look, right now we have a delta of 46. Well, if we add $1, that delta should be about 48, right? Because a gamma is 2.57. Okay, so let's add $1. You can see, there we go, about a 48. We add another $1, well, we should be at a delta of about 50, right? So you can see 51 right there because it's 2.5 gamma. So that's really all that does. And the issue here is that once you get a very steep gamma, well, that delta will really switch on you very quickly. For now, with a $2 here and there, it doesn't make that much of a difference. You know, even as you start continuing to accelerate, you can see your gamma is really only at about a 2. This is more of an issue when it comes closer to expiration. But as you can see here with a 2, it's not as big of a deal. Now, if I bumped up, let's say, to 20 contracts, well, now all of a sudden, well, you can see if I move this up $1, you know, my delta is 968, but the next time that delta is going to be about 1,000, right? So take a look, there you go, about $1,000 delta because the gamma is 51. So as you start trading larger, you can see the numbers become much bigger and a little bit more violent, okay? Now, let's take a look at our theta risk. Theta risk is the time risk, okay? So all that does is tell us how much fuel we have left in the gas tank, right, with time. So every day we lose about $5.60. So as we move the time forward, okay, let's reset it back. You can see right now we're starting out with a $5 loss right away, bid-ask spread. Okay, if I go 1 day, you can see we're down about $8.13 because of the $5.63 loss. Again, if I go another day, well, add $5 to what we have right now. Okay, so you can see down $13, $14. Add another day, we're down about $22. Add another day, we're down about $27. So you can see that every day you're losing $5.60, $70, and this continues to accelerate with time. So as you can see, as I continue to increase the date or move it forward, that theta continues to climb to about 7, then 8, and so on. It'll continue to accelerate, and your losses will continue to add up with time. So that's what theta tells you. And Vega is the volatility risk because options are based on pricing, or the pricing of options is based on also volatility risk. So if you look at the volatility, which is a little difficult to get, you got to hit a gear icon, and some trading platforms are a little more difficult to find these things. Well, let's say I move 1 percentage point in volatility right there. So you can see if I go 1, well, we go up about 30, okay, because this position is a positive volatility position. It's positive 33. So think about it. 1 percentage point, add 33 to our negative $2, $3, $5 loss, and you get about a $28 positive on that position. Okay, let's go with a positive 2. If volatility increases 2 percentage points, you're up about $63. Okay, let's just say you go 5. Well, you're up about $163 there. Now, keep in mind, when volatility increases, usually price actually goes down. So all of these things are working together, right? You have price risk, you know, you have theta risk, and you have Vega risk. So it's kind of like, well, you know, your car is overheating, well, that's one problem you have, but you're also low on gas. That's a different problem. And you're kind of going a little slow. So that they're all different issues. They all work together, but they're kind of separate components, right? So you need to keep your car cool, but you also need gas in the gas tank, and you need some speed to get to your destination. So that's the same thing here is, yes, volatility, if it increases, it will help you, but you're going to have a pricing problem because volatility increases usually when price goes down. So they work hand in hand, that overall, these are your indicators. This is what you're watching, but this is how they work. Let's go into the volatility the other way. So let's say you lose one volatility point here. Well, you'll be down about $34, $35 because you're positive Vega, which means you lose one. Think of it kind of like a delta. It works in a way similar to a delta. You lose one, well, now all of a sudden you go ahead and you lose about that $34. If you go down 2 volatility points, well, you should be down about $68 by then. Now, if price moves up with that, you could be kind of breaking even or up $30, but in general, this is how these things work, okay? So I hope that makes a little more sense, simplified it for you a little bit. Think of them as indicators. This is really how they work, and it depends on the option spread and position that you have. So let's say I go ahead and switch this and sell an option. Now all of a sudden I'm negative Vega and I have a positive Theta and I have a negative delta. So that means that with time, let's just say we move 5-10 days forward, well, I'm actually already up $48 because we have a positive Theta. And in this case, volatility, 1 percentage point move up, actually, let's just reset it, will hurt me. Okay, if I go to 2 percentage points, it'll hurt me again because I'm selling options or I'm a negative Vega. Okay, and the delta will work opposite here as well. So if we go ahead and reset this, we go back to zeros. Delta, since we're negative delta, well, if we go down $1, we are up about $41 because our delta is about 43. Considering the bid-ask spread. If we go down $2, okay, now we're up about $84, okay? So that's how that really works. And if you go the other direction, positive 1 on the price, well, because of the delta, well, now you're down about $48, $50. So I hope this makes a little more sense when it comes to the option Greeks. Think of them like indicators. Delta and gamma are your price risk. Theta is your time risk. Vega is your volatility risk. It really just depends if you're positive or negative on these, and that's how those gauges work. And all this is your command center to look at, well, hey, am I having a pricing problem? Am I having a time problem or a volatility problem? Anyways, thank you so much for joining me today. I hope this makes a little more sense. If you have questions, feel free to reach out or ask a question or get on our newsletter list by clicking this button right here and entering your name and email address when you get there. Otherwise, continue to join us on YouTube, hit the subscribe button right here, and I'll see you in the next video.